Hi traders, welcome to our 7 steps for strategy construction live video stream. And in this video series, we are on part 6 out of 7 in this video series. And today in this part, what we're going to be taking a look at, it is the RM component. What is this RM component? How can you use it in your strategy to optimize it towards enhancing its edge? This and more in this live trading session video. Hi traders, thank you for joining the Master the Markets team in our video series, 7-part video series today, and supporting us in our mission to spread the truth of trading and help you achieve consistent trading performance. It is Thiru Narpan here, founder of Master the Markets, Elite Traders Conference and the Traders Open Day. So here we are traders on the RM component. Let me quickly go on to the charts over here. Let me show you a live stream. I think I'm on the wrong one over here. Let me just see if I can continue on this. Let's see, is this the right one? Just to give you an idea of this charts over here that I've got, let me just minimize that for a moment. That's great. Let me just pull up one of it. Let's even say if it's even on Bitcoin. Even we were analyzing this as well earlier on today. But you see traders, so for example, even if you're looking on a weekly or on the 4-hour time frame, how do you actually manage your risk? How do you actually manage your risk in terms of when it's a low probability setup, right? Or a high probability setup? How should you be doing it? What different types of sections of your crib sheet or your strategy rules should there be as well? So I'm going to be analyzing all of that, okay, and how we should be approaching risk in general in real time when you are trading. Okay, so let's go through that a bit more in detail. For those of you who haven't watched the previous steps, right, highly recommend you guys to go to our channel. Okay, so let me just bring that up over here. Open link in new tab. Over here, Master the Markets 2010 channel over here is what I want you to be looking at. And you can look under streams, and under streams, we can see all the previous parts in strategy construction. Highly recommend you guys, if you are quite new to our kind of content, also to check out the 7 steps to consistent trading performance. Check from part 1 onwards. Okay, so it's really good, and it all talks about why the smart money framework is really important. Quantification of these tops and bottoms are very important towards getting a consistent point of entry. Okay, so with that said, let me actually carry on to today's topic. Let me just bring that on to the weekly over here, and let me swiftly move on to over here. In terms of your crib sheet, okay, we've been taking a look at the strategy rule set. There should be 3 subsections in your risk management section. What do I mean by that, right? Well, why should there be 3 subsections? What are they? What should they be, Tiru? I don't really get it. I'm going to cover all of that in just a short while. So what should that all basically be? The first thing is, traders, in terms of your crib sheet, you should have a subsection called the pre-trade. That means before you get into the trade, what should your risk be? You should predetermine all of that, right? I'm going to go in more in detail, so just stay with me on that part. The next thing is, what we also need to then take a look is the intra-trade risk management. Intra-trade, yeah. When you're in the trade, how do you want to manage your risk? Finally, it's called the post-trade. After you come out of your trade, what is the kind of risk that you should be looking at? This one, not many people really talk about the post-trade, right? I'll come to that in a minute. So in essence, in your crib sheet, as you subdivide it under risk management, there should be 3 subsections: pre-trade, intra-trade, and post-trade. Okay, so let's go into each one of them a bit more deeper. Okay, right. So the first thing that we should be taking a look at in terms of the three subsections, okay, for your risk management, we should be taking a look at the pre-risk management, the pre-risk management. The pre-risk management traders can either be a standard or variable. Now, what do I mean by that, right? So let me just bring up one of the things on there. If I can bring that up, just give me a minute. There we go, the crib sheet template. There we go. So we got the pre-trade risk management over here. So first of all, you have to ask yourself, how much are you going to risk on the trade before you enter the trade? And how do you decide on that risk? Basically, it can either be a standard risk management or variable based risk management based on probabilities. What do I mean? So let me explain. So if it's going to be a standard risk, the usual standard risk kind of managements are percentage risk managements, okay, based on your account size. So for example, on certain trades, you will always say that I lose not more than 1%. You can do less than 1%, but not more than 1%. So that's a fixed risk management. Or instead of rather doing percentage risk management, you can also do fixed size risk management, fixed lot size risk management. That means, so for example, if you're buying currencies, you would just say, you know what, I'm just going to stick with one lot. All the time I'm going to buy is going to be on one lot. But then you can add one more rule saying that it's either going to be one lot or it's never going to exceed more than 1 to 2% of my account size. Okay, whichever is smaller. Right. So that's one way on the fixed, on the standard size. So it's going to be the standard for all kinds of trades. You don't make any bias. Or you can then say, the last thing before I come to the other one is, and you choose. Let's say some of you might say, oh, Tiru, but the one lot, sometimes some trades might be losing more. Some trades, the risk might be more. That's why we then fix it, we standardize it with a percentage risk management of the account as well. So we combine both, right? But also another thing is, how do we decide? You might say, how do I decide if it's going to be one lot, 0.1 lot, or it's going to be two lots? How do I decide that? Or 1 to 2%? How do I decide all of this, Tiru? The way you do that is based on your drawdown analysis, which I'm going to go through a bit more in detail later on. Okay, from your drawdown analysis, let's say from your strategy drawdown analysis, the maximum peak to value drawdown of your strategy can only be, let's say, 5%. So based on that, then you can then decide that if you did a one lot risk management, according to that, usually according to your strategy, let's say you're going to be risking about $300, £300 or $300 times 5 of that, that will be about 1,500 maximum drawdown that you will be going through. Okay, another way to also measure it is by, if you find it by the raw units drawdown, by how many pips does your strategy have a maximum drawdown, or points if you're trading on the indexes or in the commodities. So whichever that may be, then you calculate it in terms of raw units, and then you convert it and find out what that standard lot size can be for you. So that all this you're doing so that you're pre-warning yourself and preconditioning your mind so that you don't get shocked when you go through those drawdowns. Okay, so whatever that you choose, keep it consistent. It's very important. Okay, it's going to be on standard risk, so you can either do percentage, fixed lot, and you base it on your drawdown. The next thing, traders, if you want to base it on variable means, if let's say you are doing a standard of 1% risk management, but on certain trades where the probability is not high, for example, if you get a very big oversized bar and you know in your testing that big oversized bars do not generally do well, you can reduce your risk, let's say, to half. Or if you got another thing that is counter going against what you're taking, and the points for validating your entry is not high enough, and if it's low, then if let's say that is based on time frame, let's say your weekly is going against you, or the weekly doesn't have much open equity left, which we have spoken about in our previous live streams, then you can then reduce it to more lesser as well as 0.25%. This is what we call variable based on probability, and you have to write down the rules for them as well, also backed by all your testing from before, and also most importantly on your logic as well. Okay, so that's on the pre-trade risk. All right, so enough of that said from me. Now we carry on to the next one, which is the intra risk management. What do I mean by this intra risk management? That means to say that while you are in the trade, so let's say, for example, let's say here, let's say if I take up maybe GBP USD or the S&P. Let me take the S&P for example. If I take the S&P for example, once I'm in the trade, let's say for example in this trade that I'm in at the moment, highly probably I think that this bottom is going to confirm today. But this is in a downtrend. That's what I'm seeing over here, price structural failure. We see, for example, if I want to take this long, right? Let me give you an example. If I want to take this long, now, but this is a phase two, so it's a counter trend in a downtrend. I'm taking a counter trend. So, firstly, as I gave in the previous example, I do a lower risk management because I'm taking a counter trend trade in a buy position. But on the other hand, in terms of intra, right, while I'm in the trade, because I might be counter trending, I could put a rule in my crib sheet rule saying that if I go back to here, I will scale out when it hits a certain point of target. That's what I can probably start to write in. Scale out when it comes to, let's say, 50% OE, and then the last of it I can scale out fully when it goes to 20% open equity point. Or in other words, I can also have an interest rate risk where I say I scale in when it hits certain levels and it goes in my favor and I break even as well. So a combination of your trailing stop loss comes in and your scaling in comes in as well. And how much are you going to scale in terms of percentage or in terms of lot size? All that you have to decide and write it all down in your risk management component under the subsection of intra-trade risk, scaling out or scaling in. And especially if you have adverse case scenarios where the trade is going really nicely in your favor, and then suddenly traders, the worst case nightmare where you get a big fat seller bar because of some news that has been affected. Okay, how are you going to come out of that position? Now, every professional trader will know how to respond when things are not going well, rather than just knowing what to do when it's only going well on their favor. Okay, so those are the things that you must know. All right. So that's in terms of your intra-trade risk. Okay. So now going back to here, the last third subsection, remember, is the last thing is your post. Okay, is your post thing that you should be looking at. And as I mentioned, some of you who have not watched our previous steps, highly recommend for you guys to go to our channel, Master Markets 2010, right? And then under there, go under streams and go under, if you take a look over here, go under the 7 steps for strategy construction, okay? And you can take a look at all the different parts from before. And for those of you who want to see how you put all this together and everything, you can always go and watch our 5-day video course, okay? traderstarterpack.com. You can copy and paste this link and then you can go and watch that as well, okay? If I were to just do that very quickly, I think you can see that if you just copy and paste that, and if you just go onto here, and you can see that over here, yeah, just put your name and email address and number if you want to for live trading updates. You can get the 5-day video course, so that will give you a good comprehension on how to put things together in terms of a strategy. Now, swiftly going through the third subsection of the risk management component, the last one is basically your post. Okay, your post risk management. In your post risk management over here, you got the different 4 types of different expected drawdowns that you should know about. Now, what do I mean by this? After you come out of your trade, okay, post trade, after you come out of your trade, you should look at your strategy and see how is your strategy performing in terms of its drawdowns? Okay, now let's go back to here. And what are the 4 types of drawdowns that we should be looking at? Okay, is what we should be looking at. Right. Before that, yeah, anyway, let me just explain this to you, and then we can go through some of this as well, and our performance and everything that we've done. The first thing we should be looking at is peak to valley drawdown. Okay, we explain more of this all in the video course on Traders Basecamp package and all of that. But just in a normal generic manner, peak to valley is basically how much is from the highest peak to the lowest point before it hits a new peak again. That's for the peak to valley. Next thing you also need to know is your month by month drawdown, and the other thing is your trade by trade drawdown. And then of course, if you're trading bigger funds like for hedge funds, institutional traders, and all that, you must also know your net asset value at the end of each day, and usually this is also required for funded trader accounts. In other words, net asset value is your unrealized loss or your profit at the end of every day, because they want to protect their equity in the um, hedge fund or the collated funds that they have. All right, these are all the post-trade risk review. Now, why do you have to do all of that once you come out? The reason is towards one question: when do you need to stop running the strategy? This is what all this helps you answer. When do you need to stop running the strategy, or when to stop, right? Or in other words, as the strategy stopped to work. These are the reasons. You must know when to switch off your system, or else all the profits that you've made, you can then give it back to the markets. So this is why you need to know all your drawdowns and whether your strategy is performing according to your past testing that you have done and reproducing its results. Okay, all this we measure here at Master the Markets as we publish our results in real time, mainly from an educational perspective. You can see all our month by month profitability for last year 2022. You can see in each of these tabs we have recorded every single trade by trade as well, wins and losses, every single thing for each of those strategies that you can see over there. Okay, all of this, and that's how we actually achieve 73.34% last year. But every single drawdown we are tracking to see if, as I mentioned over here, whether we are hitting any of those drawdowns or not. Okay, that's what we are looking to do. And the reason why we do that, so as to know when to switch it off, when to review it, and when to basically also go and scale up on the bigger accounts as well. Okay, now, but you see, traders, but if you look at this year 2023, last year we ended up, as I showed you, with 73.34%, very nice hefty profit, 39.70% coming from TSL primary strategy, 21.86 and 20% OE coming 11.77, altogether all totaled up 73.34% at 1% risk management on every single trade, right? Standard risk. Now, all this, but if you take a look at this year, the results have been very different, right? So this was a ride in the park. Every single month was profitability, except when in November, 8.08% drawdown. But you see, traders, but when we got to this one here, 2023, it was quite a rough year for the first 5 months, right? So if you look at a cumulative, it was all a good drawdown of over here of 11.55. So for 5 months, we were not really making the profits until June and July, where we got the big runner monster months, and we pulled our equity curve all the way up to 8.03%. Okay, so far until July, and everything is recorded down here on every single trade on each of the tabs. Now, why did I show you this? The main thing is, if you take a look, one of the strategies, right? If you take a look, if we didn't do our reviews and know our drawdowns, it actually went more than our expected drawdown, right? It went more than what I talked about here in terms of the peak to valley, month by month, and all of that. It exceeded all of that, you see. So once it exceeded that, what did we do? We will stop that strategy. right? And then we went to review it with all our traders. That's what you got to do as well. That's why this drawdown analysis, this post-trade risk review is very, very critical, traders. Yeah, you must know all of this, and that's why you need to back it up with all testings and frameworks and all that. We do a lot of testing over here. We're all research backed, mainly, so that in all essence, when you're trading in real time, you will know how to manage your risk, when to stop the strategy, when to go into review mode, and when to come back in again. All this you must know. So, coming back onto here, in the risk management component, 3 subsections, right? The pre, the intra, and the post. You must know all of that before you start to trade on forward. Okay, I'm getting already some questions, and some of you guys getting on WhatsApps and emails. If you, some of you trading view guys as well, got any questions, just type into the chat box. Other than that, if I will then take the questions later on. Let me see. Now, the final thing what I want to say, once you got these 3 subsections, is once you got that, it would be better if all your risk management components, as I said, are backed by stats as well. Okay, they are stats validated. They are stats validated. Now, what do I mean by stats validated? As I said, from your back testing and from your framework and from your open equity points, which we have talked about in the previous live stream, and that's how your risk management and your drawdowns are calculated. Then you can know when to stop it if when the strategy is not working, and when to continue. And remember this always, right? In the last interview I did with Urban Jackal, right, on he released a book on systems testing and all of that. And we concluded the same point. The biggest money is actually made when traders know when to switch off their trading system, whether it's automated or manual. Okay, so your risk management, your drawdowns, you must know them at the back of your hand, and you must always have it in a document so that you know when to stop it. So stats validated parameters are very, very important if you can align your risk management in terms of that as well. Always a reasoning behind why you're doing that, and backed by what. And if it's backed by stats, that's really, really good. Now, most of these principles talked about in traderstarterpack.com. As I said, you can always go onto here and copy that and then go onto here, and then you can then get access of those video courses. The other thing also, traders, in our signature, if you want to get hold of the framework that we have, the Smart Money Framework, you can also go on to our signature. So in our signature, all the details are actually contained over there. So even if I open up any of this, you can see over here that you can see it from here. Yeah, you can find out more about the Smart Money Indicator. It will all be in our signature. You can click on that and you can go and check it in your own free time. Okay, right. Now, swiftly moving on, I've made my point on the stats validated parameters and the traderstarterpack.com, a 5-day video course. And then the final thing, what I would say is, I have kind of covered most of the things that we need to include in the risk management component. The pre should be pre-trade. That means before the trade, you should have already predetermined what your risk is going to be. Is your risk going to be standard or variable, right? Then the next thing is intra, isn't it? Are you going to scale in or scale out when you're in the trade? And in adverse case scenarios where you get big sell-offs or big stop outs, what are you going to do as well, right? And finally, the last one is post. In the post trade risk review, you must know all your drawdowns and the 4 types of drawdowns that we went through. So these are all the things that we went through. Okay, traders, so definitely write that down in your crib sheet, and this will give you more clarity and more confidence as you trade it, and then towards achieving consistent performance. All right, traders, right? So in our next one, what I'm going to be doing is I'm going to be looking at the TS components, okay, putting it all together. That's what I'm going to be doing in step 7 in our next live stream on the strategy construction video series. I'm going to be looking at the trading TS components. What is the TS? Then I'm going to hold the suspense. I'm going to talk about it in the next one, but it's all going to put all together all the 6 steps. So some of you who haven't watched the previous steps, go and do some catch up. All right, in the time being. Traders, I guess that's pretty much that from me on this trading video over here. If there is no other questions, then I would then say till the next time, stay disciplined, follow your trading plan, and keep trading like a master.